Advanced Financial Accounting. In this presentation, we're going to work a practice problem in Excel. We're going to work a consolidation type problem where we have two companies. We're going to be consolidating together using a consolidation worksheet. We're going to say that the consolidation happened not at the beginning of the current year, but at the beginning of the prior year, where P, the first company, purchased 100% of the shares of S at the net asset price. Get ready to account with Advanced Financial Accounting. This will be similar to a prior presentation we did in the past that we worked in Excel. The difference here being that we're now in year 2. So note that this is still going to be a simplified type of problem. We're going to be building in on the complexity. That means that the purchase took place not in the current year or at the beginning of the current year. We're going to be consolidating as of the end of year 2. It took place at the beginning of last year, the beginning of year 1. And then P is purchasing 100% of S, 100% of the shares. Therefore, they have a controlling interest, but they have 100% interest. It's not just something over 51. We've got 100% interest, which will make it easier for us to see how these consolidation type of transactions will work. And when the purchase took place, it was purchased at the net asset price. Here we are in our Excel problem. So we're going to have our information on the left. We're going to enter that information into the blue area on the right. And then we have our consolidation worksheet where we're going to enter our consolidation entries or our elimination entries, however you want to call them. So here's our information. P purchases S common stock for $319,000. The S net assets were $319,000 at the time of purchase. When did the purchase take place? Not this year, but the beginning of last year. So the January of last year it took place. So we had all of year 1, then all of year 2. We're now in the end of December of year 2, where we're now going to be consolidating for the second year of operations between the two companies, P and S companies. So P uses the equity method to account for investments. So in other words, when P has a separate books, they record the separate books investment in S using the equity method, which you would think would be appropriate given they have kind of like the controlling interest there. But we also need to consolidate the books. So we're going to have to show them as one company. So now we're going to be having to reverse, that basically equity transaction. The accumulated depreciation, which is ACC DPRE, I'm going to call it, at the purchase time was $16,000. Okay, so then the information we're going to have over here. Now remember, this is as the end of year 2. And what we would do is we would take the books. We're going to say, okay, P's company, the parent company, give us your trial balance as of the end of December. And then S company, the other company that are related, give us your trial balance. They might be in two separate software systems or something like that they would want to be printing out. We would then put them into our worksheet. We might do so that we might export it to Excel or something like that, and then put it into our consolidation worksheet. Then we're going to put them up lining up side by side. Once again, notice that in practice, this is going to be more difficult than right here. Obviously, you want the GL accounts to line up as much as possible so that when you put them in your worksheet, they're easy to line up. So for example, you'll recall that just like always, if you look at your expense accounts down below, people could name the expense accounts slightly different. So insurance, they might name, break out the insurance in different ways, subcategorizing car insurance and the insurance for general insurance and stuff like that, whereas another company might be categorizing insurance differently. They might have a different account numbers and whatnot. So you're going to want to make the two companies as close as possible in practice, so that when you do the consolidation, then you're not having to kind of group a bunch of accounts together and so on, so that you could put them together in your consolidation worksheet. So note that is something that you'll have to deal with. We're not going to be making that complexity here. Okay, but it's not too hard to do. It's just time consuming to try to group the accounts that are like accounts together into your consolidation worksheet. And if you can set the two companies up in such a way where the accounts and the account numbers are much the same, the more you're able to do that, the easier this process will be. Okay, so then we have P and then we have S. These are going to be their information as of the end of the time period, and we're just going to put them into a trial balance format. We're going to compare the two of them, and then I'm going to combine them together, and that'll give us our consolidation trial balance. And then once we have that number, of course, then we need to do our reversing entries, because we'll notice that there's some accounts that we can't have there because they're going to be kind of duplicating the information. So we'll need eliminating entries. So we have our two trial balances for P and S. Let's just go ahead and sum them up. So I'm in K3. I'm just going to say equals SUM I'm going to sum up the cash for both of those, and that's it. And then I'm just going to autofill that formula all the way down. We're just totaling those two columns up, and that'll give us the total, right? If the debits equal the credits here, the debits equal the credits here, so the debits equal the credits here, and that's going to be our ending trial balance. So that looks good. And now we just need to do our elimination entries. And like I say, this is just note that that's the reason that's so simplified is because we've already lined up these two accounts. We've already lined up the GL accounts and put them into like categories, as if we had two GL accounts which were made from the same mold, which is what you would like to have, okay, but which you don't always do have, okay. So then what we'll do is we'll do our consolidation. So in essence, I know if I look through these, I'm going to say, okay, what kind of eliminations do I need to do? Well, that needs to be eliminated. I can't have an investment in S when we're representing now the numbers as if we're one company, and S is like part of the one company we're representing. That's got to go. And then if I go down here, I'm going to say, what else? Income from S, so I can't have that. I can't have income from S when we're representing ourselves to be kind of like what S is at this point. So we need to eliminate that. Where's the other side of this going to go? It's going to be part of the equity section. So it's going to be a part of this equity section here. So note, it might be useful. We did a prior problem where you can do this in year one, which might be easier to actually see this. Note the equity transactions look like this. So the investment in S, journal entries to get to these ending numbers on an equity basis was to increase. What must have happened? We increased the investment in S by the 51,000. So that's the net income for S's net income. So, and then the other side went to income from S. So there's the income from S. So there's the 51,000 that S earned, representing the income from S, and then P recorded that on their books as income from S, and the other side increasing the investment in S up top. And then we could see when the dividends went out, S gave out dividends, 36,000, that went 100% to P, because P is 100% owner. Therefore, cash went up for P, and the investment then went down. So in other words, this one line item, because we're using the equity method here, for P, and they bought 100% of S for the net asset value of S. So that means that this net asset is basically representing assets minus liabilities. So assets minus liabilities is the 472,000. There's the 472,000. And we know that assets minus liabilities equals equity, which is all the blue accounts, equity and the income statement. So there's the 472,000 being represented by the 472 here. So basically we need to remove this, we need to remove this, and then we need to remove the equity section, and we should be okay, right? So in other words, if I was to remove this, holding down control, remove this, and to remove this, we'd sum up to 0. There's our journal entry. That's what we need to eliminate right there. Okay, so let's just go ahead and do that. We're going to say, all right, then we got to get rid of this, eliminate this stuff. So I'm going to say this equals the investment. It's got to go down. That thing's got to go away. It's on the books at a debit of 472. So I got to make that go away. So I'm going to credit it because it's a debit and I need to make it go down. So I'm going to do the opposite thing too. I'm just going to credit that one. And then I know that this needs to go, like the next thing I know is that this needs to go away, right? That's got to go. So that's got to go for sure. That's got to be part of the journal entry. You can't have it income from yourself, right, being reported. That's got to be some kind of intercompany eliminating type of transaction. It's on the books as a credit. So I need to get that off the books completely by just debiting it. And then I know the other side is in equity. The other side is this equity portion. Now it doesn't represent, the income has already been shown. It's the 51. We accounted for the 51 here with the investment in income. So now we just need to remove basically the equity portion of S. So I'm just going to remove all those. And those are, common stock. Let's go to common stock and say, all right, there's common stock for S, and it's got a credit in it. So I'm going to debit it to make it go away. We're going to make that go away with a debit. And then we got the retained earnings, and it's got a credit in it, and we're going to make it go away with a debit. So I'm going to debit that to make it go away. And then we got the dividends, and the dividends went to ourselves for S company. S paid P, and that's an intercompany kind of thing going on there. So we got to remove that. So it's on the books as a debit, so we're going to credit it to make it go away. And there we have it. So now the debits, do the debits equal the credits here? The debits add up to the 508. The credits add up to the 508, as we can see down here. And then if I add all of them up, debits minus the credits add up to 0. It looks like it's in balance. Let's go ahead and post this out. So I'm going to say, all right, here's the investment in S. Here's investment in S. I need to eliminate it. That needs to go to 0. So we're going to be in cell L6. Within L6, I'm going to say equals. Go on over to that 472,000 and enter and bring that down to 0. All right, and then we have the income from S. Income from S down below. That's got to go. That's got to go. Can't have it. Can't have that. So we're in L16. I'm going to say equals. We're going to scroll back up and pick up that one, and that should make, that's going to be the debit in E3. So that makes it go to 0. So that's gone. All right, then we've got the common stock. Common stock, we're going to go on over to the common stock. So I'm in L12, I'm going to say equals, and we're going to make the common stock go down. So, you know, that it was this for P, then here's S's portion, making the total. Now we brought it back down to basically where we started where P was, because we removed S's portion. Then we're going to do the retained earnings. Same kind of thing here, we're in retained earnings. We're going to say this equals. Scrolling up to the retained earnings, there's the 263,000. So here's what P had, here's what S had, there's the total. Then we removed S's portion. S has gone back to what P had here. Then we have the dividends. We got to remove the dividends because we paid the dividends to ourselves if we're consolidated now. So in L14, I'm going to say equals and pick up that 36,000. So there's what P had, there's what S had. S's dividends went to P. So there's the total. We removed S's dividends, bringing us back to just the dividends went out for P, the parent company, because P's dividends actually went outside to the shareholders of P, and S's dividends went to P. Okay, so there's going to be our elimination entry that brings us back into balance. So we're back in balance here. And then the other thing we got to think about is this depreciation one. So remember, at the time of consolidation, which was 2 years ago now, S's books are still showing accumulated depreciation, you know, as if it was still going there. And what we want to do is show the accumulated depreciation at that point as the book value or included in the building here. So let me show you what that looks like. And that makes more sense to explain it here. We're going to say then that the accumulated depreciation, we're going to debit. And we're going to credit the building and the equipment. And it's going to be for the amount of accumulated depreciation at the time of purchase, at the time that the 100% of the shares were purchased, which was the 16,000. Now, if we post that, then we're going to say, all right, so the accumulated depreciation, we're going to debit. It's a contra asset account, so it's going to go back up. So we're increasing the contra asset. We're decreasing the contra asset. The contra asset's going to go down, total assets going up. And then we're going to say the building is going to go down. So why would we do that? Because at the point in time that two years ago, what we're doing is we're going to say at the point, we're going to represent this as of, it's like we took the book value of S's building and equipment and put them together and represented now as of that point in time, that being the new, you know, like cost as if we purchased it at that point in time of the building and machinery, which we then depreciated going forward from that point in time. So the 16,000 represents the accumulated depreciation at the point in time that we had the consolidation, so which was 2 years ago. So that's why the problem had to give it to us here. So 2 years ago, we had the 16,000 at that point in time of the consolidation. We're basically removing the accumulated depreciation at the point in time of consolidation, recording the building and equipment basically at book value as of that point in time, and then recording the depreciation from that point forward for the consolidation process. And that's going to be it. That's basically it now. So then if we go back over here, we're going to say, all right, so yeah, we've eliminated this one. That makes sense. We've eliminated this, and we've removed basically the equity section tying, that's the other side of that transaction. And then, of course, we've got our assets minus our liabilities total here, equaling the 1,290,000. That equals the equity now of the 1,290,000. And we can use then the consolidated trial balance to then construct our financial statements.